to our mini lecture on corporate valuation that is intended to prepare you a bit for the upcoming HHL Finance Case Challenge. My name is Maximilian Schreiter. I'm an assistant professor at HHL at the chair of Mergers and Acquisitions, and I'm the responsible program director for our MSc Finance track. So let me first of all congratulate you for being selected for that outstanding challenge that awaits us next weekend. And we are all very much looking forward to welcoming you in Leipzig, not just us at HHL, but also our corporate partners from Ardien and Roland Berger. So in that little video here, I would like to give you the chance to recap a bit on corporate valuation or to get deeper into some of the topics surrounding it. So I will tell you a little bit about some basic concepts, about some common pitfalls and practical implications that arise from that. Okay, so let's get started. So as said, we start off with some conceptual basics. We will in particular focus on multiples and discounted cash flow methods, and there in particular we are going deeper into the WACC approach. After that, I'm going to show you some very common pitfalls and let's say remedies to those pitfalls that will provide some good practical implications, I hope, for the case challenge. And then last but not least, I will show you where you could get some more knowledge resources from if you're interested and if you have time before the challenge, but that's totally optional. Okay, so let's get started with some methodology. So first of all, there are obviously many reasons that could basically trigger some kind of corporate valuation. In that little mini video, I'm not going into all of them. The most relevant for us is the one in the middle, investment decision. So if we want to make up our minds about buying another company, building another factory would be also an investment decision, going into a new market, stuff like that. So in the upcoming case challenge, it will be probably about some kind of company where we have to come up with a valuation. Okay, so now what are basic principles of valuation? I think the most important one really is that any kind of valuation always means that we have to compare. So usually we have something that is the valuation subject, that we want to get an estimate for, and we need to come up with some kind of comparable object to basically make that happen. Doesn't matter whether we are talking about multiple valuation, where you guys probably know we try to figure out what is a relevant peer group, but even in discounted cash flow methods, where, as you will later see again, we are going to estimate cash flows of that very specific company we want to value. Even there it is about comparison, because when it comes to the underlying risk of that company, again, we will need to compare the risk of our company to the risk of other companies or the overall market. So it will always be a bit about some kind of comparison. And the other thing that is important to keep in mind is that values, which we are interested now, is not the same as prices. So prices is, let's say, what gets paid in the end, and values can just help me to see whether by paying a certain price I'm adding value for my investors or whether I'm destroying value for my investors. The picture you see on the right is, let's say, some kind of the ideal situation. So the seller comes to a certain valuation for his or her company, and the buyers come to another one which lies higher. So that gives them, let's say, a positive zone of agreement or for negotiation. And when they agree on a price somewhere in the middle, value could be added for both of them. How is that possible, by the way? That sellers come to a lower value than buyers? Well, that usually comes from synergies. So synergies will be probably one big topic also to watch out during the case challenge. But that's the basic idea first of all. Okay, let's move on. What kind of valuation concepts are out there? Well, The one that we are going to focus on, you see on the very right, the present value concept. We want to know what is today's value of, let's say, the future cash flows that a company is expected to create. Yeah, so that is the idea. By the way, no matter whether we talk about multiple valuation or discounted cash flow methods, in both of the cases, that is basically the underlying principle. There are some other ideas, the liquidation value and the net asset value. In that mini lecture, I don't want to go too deep into that. Maybe just quickly about the liquidation value. That would be really if we are not seeing a company as a going concern, but we basically want to stop operations. Yeah, the company should cease to exist. We would basically sell off all the assets. In restructuring projects, this is what is pretty often done, that you kind of calculate that value and later on compare it with the going concern case, so the present value calculation, to figure out whether you should maybe just rather sell off the assets that you have. Yeah? So sometimes this can be seen as some kind of lower boundary to the value. And the one in the middle, the net asset value, I'm not going deeper into that. The idea is basically that you rebuild the company on the green field and you think about what would it cost me. But that's not really meaningful, because if you think about, I don't know, a company like Coca-Cola, you can, let's say, rebuild all the assets of Coca-Cola, but probably you will not be able to generate exactly the same cash flow. So therefore not really an appropriate idea, rather something for insurance companies. But as I said, don't want to go too much into detail on that. Okay, so now after that first value concept overview, let's see what kind of methods are out there and what could be our focus here. Yeah? So obviously there are numerous methods out there. The one on net asset value and liquidation value you pretty much see on the left. Yeah, we leave them out, and also the alternative methods on the right is rather something for a master program, where we would basically think about how to value very flexible investment options that are out there, yeah, rights that I have to execute, or also startups that have very high uncertainty, where I have to figure out, okay, how can I basically price that risk, but also that huge upside potential. Yeah. So nothing for us for now. We are going to focus on the middle, and there are basically two big families, let's say, of approaches: the market approach and the intrinsic value approach. And in both of them, we are basically just picking one method. Yeah? And while this may look a little bit underwhelming, I can assure you it is not, because the two things we are looking at are basically the two most important ones. Yeah? So on the one hand, in the market approach, we look into multiples, and there into the similar public company method, which, as I will explain in a moment further, is basically the idea that you are looking for companies that kind of have the same operational risk, business model than the company or as the company that you want to value, and then you try to see what is the value of those peers and what are some value drivers, earnings, cash flow, stuff like that. Yeah, and then you build up a relation, a so-called multiple, and that is what you then apply to the company that you are going to value right at the moment. Yeah, so that is the basic idea. We go deeper into that just after those introductory slides. And then on the other hand, we have the intrinsic value approach, where, let's say, the most important subfamily, so to speak, are discounted cash flow methods. Yeah? Just as the name says, the idea is that we are estimating future cash flows of the company we want to value, and then we discount them back to today. Discounting always means that we need to figure out for an alternative investment what would have been my return, and then I calculate backwards, so to speak, what would I need to invest today to basically have the same expected cash flow in the future as we have just estimated for that company? Yeah, I'll also show that in more detail, but that's the basic idea. And then fortunately or unfortunately, there are many different of those discounted cash flow methods. The one we are going to focus on, and that's also the one that most of the practitioners are applying, is the WACC approach, weighted average cost of capital. Here we need a so-called free cash flow to firm. I'm going to show you that. And we will always go with a constant weighted average cost of capital that reflects, so to speak, the return expectation of equity investors and debt holders at the same time. Yeah? But as I said, we are going to define that further. Okay. So why those two methods? I should give you some motivation on that. The reason is basically that is what is most widely used. Yeah? Therefore, we are also going to cover that. Let's say in a full-fledged corporate valuation lecture, we would obviously also discuss what are some good, let's say, theoretical backbones of really applying those two methods. I believe there are some good reasons for that. But for the moment, let me just motivate it with the fact that really out there, professionals and experts are really using those methods. Yeah? Okay. And the other thing, so that's also the reason why we are not just covering one method. The other thing is that usually if you run a corporate valuation, you apply several methods to kind of, or with the aim to get a range of valuation, because there is usually not that one true value. Yeah, there is a lot of uncertainty in there, obviously. Yeah, a lot of assumptions to be taken. So you may want to do several methods, some kind of multiples, and then maybe that WACC approach, and that will give you a good feeling for the range of the true value, so to speak. Yeah, and this is what you see in that slide, that people are pretty often doing this. Okay, so before we now go deeper into multiples and the WACC approach, we have to establish, unfortunately, some more terminology. Yeah, so I have now said value a lot, or valuation, but the thing is that there are different kind of values that we quickly need to define. Yeah? So what you basically have to pay to the owners of a company is basically you have to pay for the equity. So you would be interested in what is the so-called equity value. Yeah? What is the value that the current owners of the company have by holding their shares, so to speak. Yeah, that's the equity value. But the thing is, the equity value is something that you can also try to calculate directly, for example, by the equity approach of the DCF methods, or also with some of the multiples. Come to that. But usually that's not such a fortunate idea, because there, let's say, the value ranges are way more volatile, yeah, due to the so-called capital structure, the mix of debt and equity that you also have to estimate up front. So that often makes things more complicated. So therefore, what we usually do is we try to estimate the so-called enterprise value. That's the concept you see in the middle here. And that enterprise value is, so to speak, the value of the company that belongs not just to the equity investors, but also to the debt holders. It is the value, let's say, of all the operating assets of the company. What we usually do not take into account here, first of all, at least, when we do our valuation, is everything that is non-operational. What is a classic non-operational asset? Probably sounds a little bit weird at first. Non-operational assets is, for example, any kind of excess cash. Yeah, so if companies have just cash lying around that are not needed to run the operations, there would be non-operational assets. Yeah? And our valuation is, first of all, not detecting the value of that. Yeah? We are calculating an enterprise value, for example, with that WACC approach or with different kind of multiples. And then, let's say, we could add those non-operational assets to figure out what is the firm value. Yeah, that's the concept on the very left. And let's say if we have that enterprise value from our well-established methods to then go down to the equity value, because as I told you, that's the one that is usually relevant, let's say to figure out whether you are paying a fair price or not. What you do then is basically you deduct the value of the debt, so the debt that is outstanding, what you owe to the debt holders, and you reduce that debt by the non-operational assets. We call that the so-called net debt. So that's the other term that you see here, and that, so to speak, fills the gap between the equity value and the enterprise value. So we calculate downwards from the enterprise value towards the equity value. As I said, by first adding back the non-operational assets and then by deducting all the debt that is interest bearing and outstanding. So usually all financial liabilities and maybe also pension reserves that you have. Not here in that mini lecture, but in the documentation that you also get. So in the slides, there will be another slide on that tells you a little bit more what could be part of that gross debt. But I don't want to go into detail here in that video, but it is out there for you to look up, and obviously also something that we can discuss during the case challenge. Okay, so I know that was already some kind of input, but we have to go further, but now it will become more specific. So first we are going to visit the multiple valuation and then, as I said, the WACC approach. Okay, so let's get into that. Multiple valuation. Really quick, in a nutshell, here comes the idea. We always need to pick, let's say, some kind of value concept. We obviously now know 3 of them. Firm value, enterprise value, equity value. And for all of them, there are consistent value drivers that are going to help us to make up some kind of multiple. So let's say if we want to build up multiples on an enterprise value, then the underlying value drivers would be stuff like EBIT, EBITDA, or also the so-called NOPAT, net operating profit after tax. I'm going to define that further later on. But let's say all kind of value drivers that still belong to both the equity investors and the debt holders. So it has to be, let's say, before we have paid out interest payments. So they have to be still part of that. If we have already paid them, then the debt holders are taken out of the equation and we are just looking at equity investors. In that case, we would basically need to go for an equity multiple, and the underlying value that we are then estimating is not longer the enterprise value, but the equity value. So if we are interested in the enterprise value, EBIT, EBITDA, NOPAT would be the stuff to look at. On the right hand side, you see what relates to an equity value, and that is also something that people often do, but it has some issues. I don't want to go too deep into that. Also something that we can discuss during the weekend, but it can be pretty heavily distorted by capital structures of your peer companies. And firm value multiples is usually nothing that you would go for. Later on in the pitfalls, I tell you a little bit what could go wrong and what you should basically watch out for by distinguishing firm multiples and enterprise multiples. Okay, obviously maybe a little bit about advantages and disadvantages of multiples. Big advantage is, first of all, it's simple, but second of all, it also has some kind of, I would say, objectivity, right? Because that's something where you basically look into market data, you try to find good peers that have, let's say, the same underlying business risk. You see what is their value at the moment, their enterprise value. You put that into relation with some of their accounting data, so EBIT or EBITDA, And then you have a multiple that you can apply to the company that you want to value. Yeah? And that is, first of all, a very well-established procedure, not so much of freedom in that, so to speak. Yeah? Obviously, if you look closer, there is still a lot of freedom, because what is basically an appropriate peer group, yeah? and people use that a lot, yeah? Bringing in companies that basically tilt the multiple or the average multiple in the direction they want. Yeah? But first of all, it's a well-established procedure, and that's definitely an advantage. A disadvantage is that you very much rely, let's say, on the movements of the market. Yeah? So if the enterprise value of some publicly listed company is just pretty high because we are in some kind of bubble, or pretty low because we're in some kind of burst, then that's obviously something that will directly affect your valuation. Yeah. Okay. So that is a little bit an introduction into that. And now, very quick, very simple example of how to calculate. Yeah. So in the hope that if the last slide was still a bit too conceptual, that you can basically get your head around that. Yeah. So here we have one company. It's a publicly listed company, so therefore we have all the data we need for building up our multiples. Yeah, we know the revenues, we know the EBITDA, the EBIT, we also know the net profit, and we know the share price and the number of shares. With the share price and the number of shares, if we multiply that, we can basically figure out what's the equity value. So in that case, it's, let's say, 18.1 million. That's the equity value. And now you guys, please remember from the previous slide, the equity value is nothing that we can put into relationship with a revenue, EBITDA or EBIT. Why? Because those three line items are basically before capital structure, so to speak. Yeah? So the debt holders still participate in those numbers, yeah, because interests have not yet been paid out. So therefore we cannot put that into relation with the equity value, which only belongs to the equity investors. The only consistent multiple we can come up here with, in our little example, with the equity value, is basically putting the equity value in relation to the net profit. Yeah? And sometimes people call that the equity profit multiple, but more commonly it is called the price earnings ratio. Yeah, so whenever you hear price earnings ratio, that is basically what has happened. People have taken the equity value and put that into relation to the net profit. And that's a consistent multiple. Yeah? As I said, it has some weaknesses if you go into more advanced theory, but that's one thing to do. Yeah? Okay. Then on our way up to the enterprise value, we would need to check out the balance sheet actually. Yeah? So we would need to see, okay, what kind of liabilities are outstanding that are interest bearing. Yeah? So it always has to be something where I have to pay interests for, and then that could be current or non-current. The difference current, non-current is current is anything that has a maturity below 1 year. Non-current has a longer maturity. But in current, it's really important that this is not about, for example, liabilities that you have against your suppliers, yeah? So-called accounts payable. Why? Because you're not paying interest to them. But it could be short-term financial liabilities, yeah, that you have to redeem within the next year. And then, as I said, could be long-term liabilities, again loans, but could also be pension liabilities that you have. Yeah? And then basically non-operational assets would be something to deduct from here. If there are minority shares, a little bit of a special topic, you would need to add them back. They are like liabilities, yeah, like debt holders for you, so to speak. Yeah? And that brings you to the enterprise value. Good thing is, if you look into publicly listed companies, usually that enterprise value has already been calculated for you. Yeah? So standard balance sheet line items have already been corrected for you, and then you have that enterprise value. And the enterprise value is something that you can put into relation with sales, EBITDA, or EBIT to build up a consistent multiple. Yeah? And now you would basically do that for several companies that you regard as being comparable, as being good peers for the company that you want to value. And then you could build up an average or a median of those multiples that you have calculated for those peer companies. And then you could apply this mean or median to your target company to get some estimate value range for that company, either enterprise value or equity value. Yeah? Okay, so that's the idea how multiples work. And on this slide, I try to summarize a little bit on, let's say, some good procedures when doing a multiple valuation. Yeah? So first of all, which multiple to take? Here, definitely my recommendation would be to go for enterprise value multiples, as I told you beforehand, because they are not distorted by any kind of capital structure. And I would stay away from the revenue, because the revenue is obviously before any kind of cost structure. So therefore EBIT or EBITDA is a good idea to take. For some time, people thought it might be a good idea to relate the enterprise value to some kind of cash flow, because the discounted cash flow method also goes for cash flows. But that is not such a good idea, because cash flows are pretty often fluctuating a lot. Profits are not fluctuating so much, so they are way more robust. So therefore that would be the recommendation, EBIT or EBITDA multiple. What is better in a specific case is also something where we would need more discussion on, but at least this should give you some first rough guidance, I would say. So then on the peer group, I mean, all you guys have had some kind of statistics or research methods courses, and there we would usually say try to get the sample size as big as possible so that you can basically come up with a more stable estimate. The thing is that does not hold true for multiple valuation. So here you should really try to focus, let's say, on finding an appropriate peer group where really the business risk or the business model is very close to the company you want to value. That is way more important than increasing the sample size. You may just end up with 2 or 3 good peers, but the result will tell you much more than, let's say, if you take some kind of industry multiple. That's also sometimes what people do. They have an automotive company that they want to value, and they just take the whole listed automotive sector. And now let's say the company they want to value is a little very specialized supplier, and in that industry multiple there are all the big OEMs built in, BMW, VW, and so on and so forth. And obviously the business model, the business risk is not really comparable. So then it makes much more sense to just go for 2 or 3 peers that can be compared much better. Okay. All right. And then about the time frame, that's also something that is always a pretty challenging task, because usually we would always say, well, it should be something in the future, because we are not paying for the past. The past is gone. The thing with the future is hard to estimate, or you need to find good estimates for different peer companies. So sometimes you have analyst forecasts, but question is whether the analysts are really smarter than you are. But let's say if it is kind of a 1 year forward, so where we are maybe already in that year and there is an estimate even by the company itself where they are going to end up at the end of the year, then that might be a good choice. Otherwise, really take the last financial year or the so-called trailing values of the last 12 months. That is usually good enough. It's not forward looking, but it's still quite recent, and it is something that is well established, that has not so much of a volatility or guess in it. So that would be my recommendation here. And then about the aggregation, so I told you do that for several peer companies, and then you need to figure out how to aggregate that to apply it, so to speak, to your target company. And there I would always recommend to do a mean and a median. The mean has the advantage that it reflects all the values of your peer group. The median basically just takes the one in the middle, or let's say the middle between two values, if this is not an odd number of peer companies. So let's say it ignores some values, the mean doesn't, so that's the advantage of the mean. On the other hand, the mean might be pretty much distorted whenever you have outliers. So let's say there is one company that has an EBIT multiple of 350, and then you have just 3 or 4 other companies in a range of, I don't know, 8 to 12. So then obviously the mean will be totally distorted. And the median is very, very robust when it comes to those outliers. So whenever you see that the landscape is very scattered, so that you have really high variations to the top or to the bottom, then it might be a good idea to go for the median. If it is just about 1 or 2 huge outliers, I would basically eliminate them directly, and then you could also go for the mean. So that's a little bit of a recommendation on that end. Okay, so that concludes that little introduction to multiple valuation, and now let's go into the WACC approach. So the overall idea of any of those discounted cash flow models is basically that we figure out what is the present value. And the idea is that we make up our minds about future expected cash flows. You see that here in the very first line. There are some kind of cash flows estimated over the next years. And then we, as we say, discount them back to today. We find their present value. And why we do that, you basically see on the bottom of the slide that we say, hey, there is always some kind of initial investment to do to basically come up with that expected cash flow in the future. And obviously such an expected cash flow of the future has to be triggered or created by some kind of return expectation, and this is what we call the discount rate. And what is important is that the discount rate that we take has to be, let's say, our return expectation for an alternative investment in the same risk class. So let's say you have a super risky company, then you cannot go with the government bond rate as a discount rate, because the government bond is probably much less risky than the company. You need to find something that has the same, that lies in the same risk class. Okay, that's the idea behind such a discount rate or alternative investment return. So in our little Mickey Mouse example here, it's 10%, and we have those expected future cash flows. We discount them back to today. We do that for all the different cash flows. The first year, it's basically divided by 1 plus 10% to the power of 1. Second year, 1 plus 10% to the power of 2, because you can basically earn a return on a return. Therefore, it's to the power of 2, and so on and so forth. We find those present values, we add them up, and then we have some kind of idea of the total present value of that company. What is important is to look into what you see orange or gold here on that slide, which is the so-called phase 2, the terminal value. So here in that little Mickey Mouse example, we have cash flow plans for the first 3 years. And then starting from year 4, we jump into something that we call the phase 2. Sometimes it's also called the steady state phase. And where we calculate a terminal value. So here we expect that the cash flow of 160 stays constant, and then we basically do not have to discount each and every single year to infinity, but we can basically come up with the perpetuity formula. Also something that I'm not going to derive with you today, would be also something for a longer lecture. We can basically just divide that cash flow estimate by the discount rate directly. So 160 divided by 10% here, that gives us the terminal value, and the terminal value starts in year 4 and goes to infinity. So therefore that formula 160 divided by 10% tells us the value in year 3. So terminal value starts in, or the steady state starts in year 4. So the terminal value we calculate is a value of the year 3, which means we need to discount that back to year 0. So therefore we divide the whole thing again by 1 plus 10% to the power of 3. So now obviously, just to make that clear, if we have a terminal value where the steady state starts in year 6, then the terminal value is a value of the year 5, and what we calculate is something that we would need to discount back by another 5 years. I hope that is an idea that becomes more or less clear. Also something to discuss further over the weekend, but you should already have some kind of idea about that or have heard about that. Okay, and then maybe one other thing that I'm already going to mention here is that obviously pretty often we do not think that the cash flow keeps constant over time, but we think that there is a constant growth rate attached to that. We call that the perpetual growth. Could be 1% or 2%. In the pitfalls, I tell you a little bit how to figure out what is a good discount, what is a good growth rate. But let me for now say, whenever we have something like that, so let's say 1%, then we would basically just need to alter the formula a little bit. So instead of taking 160 divided by 10% for the terminal value, we would basically take the 160 divided by 10% minus 1% in the denominator, 10% minus 1%. So we just need to deduct the growth rate from the discount rate. So that's the one little adjustment we need to do if there is some constant perpetual growth involved. Okay, so that's, let's say, a very, very rough, quick intro to that discounted cash flow idea. And now let us see how the weighted average cost of capital concept works. You see already on the right, there are some other discounted cash flow methods, but nothing that we are going to focus on now in that mini lecture here. I really just want to talk about the so-called WACC approach. And here the idea is that we have some kind of free cash flow to firm as our cash flow. I'm going to define it further on the next slide. And then we discount by the so-called after-tax WACC. WACC, weighted average cost of capital, is a mix of the cost of equity and the cost of debt. Also something that we are going to detail just in a moment. Okay, so let's look into that. So first of all, this cash flow concept, the so-called free cash flow to firm. So here you can really start off with what you find in the profit and loss statement. You can go down the profit and loss statement to the EBIT, earnings before interest and taxes, that's fine. And then something very odd happens. In that free cash flow to firm concept, people are now deducting taxes, but not after they have deducted interest, but basically just directly calculated on the EBIT. We all know that's not how it should be. Yeah? So in the profit and loss statement, you would first deduct interest. You would come to the EBT, earnings before taxes, and then you calculate your tax payments based on that EBT. But in that free cash flow to firm concept, you do it differently. Yeah? You keep the interests in the tax base, and then you calculate what I would call calculatory taxes, yeah, because they are not the real taxes you pay, but it's really more a calculatory item. Yeah, it's the tax rate times the EBIT. What are reasonable tax rates, by the way? Yeah, so in Germany you can go with something around 30%. Yeah, so that's the sum of the so-called Körperschaftssteuer, 15.625%. And the Gewerbesteuer, that's a local tax. The first one is a federal one. Yeah? And that local one is depending really on the city or the county you are located in. Yeah? But it's usually roughly around 15%. Yeah? So just that you have a little bit of a feeling. 30% is a good estimate for Germany, or 32%. Yeah? I know maybe some other examples. The UK, I believe, is at the moment at 19%. Netherlands are at 19%. Poland are at 19%, so that you know some neighboring countries. The US was always much higher than Germany at 38%. Since the Trump presidency, it got lowered and is now also a little bit more complicated because it basically depends on the size of the company. I think it's 15 or 25%. Depending on the size of the company. Yeah. So just that you have a little bit of a feel what is a good number here. Yeah. Okay. So, but having deducted those calculatory taxes, and I will reveal in a moment why people do that. Yeah. So why they are not deducting the interest and why they basically calculate taxes in the wrong way. Yeah. We talk about that again, but let us first take that for granted and see what's the result. It's the so-called NOPAT, the net operating profit after tax. I mentioned that beforehand for multiple calculations. You can also use that to build up a multiple, although it's not so common, to be honest. But it's possible. So what we find here, the NOPAT, is already a profit after tax, but it's not the real net profit from the P&L because we forgot interest and we deducted too much of taxes, right? Okay, still, let's say that's an after-tax profit, and now that profit needs some adjustments because, as you hopefully have heard in some kind of accounting class, profit and cash flow is not the same. Yeah, so there are different things that we have to correct when we want to calculate a cash flow. The very first thing is we are adding back depreciations and amortizations because depreciations is something that just happens on paper. Yeah. So you have a machine, you once bought that for 1,000, you depreciate it over 10 years. So that means in your profit and loss statement, you deduct depreciations of 100 each and every year, but that's not really cash outflow. It's nothing that goes out. It's really just happening on paper. It's important to have that in the P&L because there you really want to understand what is, let's say, the performance of the company in a specific period, and any kind of investment should be basically spread out over the useful life of that machine. Yeah, but cash flow wise, we need to correct that. Yeah, we want to add that back because it's not a cash outflow. Yeah, so we do that. On the other hand, yeah, anything that is a capital expenditure, we need to deduct. Yeah? So let's take the starting point of buying that machine for 1,000, as I just mentioned. That is something that you are not going to see in the profit and loss statement, yeah? Because you buy that, you pay that, let's say, with cash, yeah? And you put that into your balance sheet on the asset side. It's nothing that affects your profit and loss statement. It just affects the profit and loss statement over the next years, yeah, by depreciation. Yeah. But cash flow wise, we need to deduct that now directly, yeah, because it's a cash outflow. So everything that is a capital expenditure, we deduct. And then last but not least, we basically adjust our cash flow for changes in net working capital. So now what is that? Usually I also spend at least, let's say, half a lecture, maybe even one full lecture just on that topic. I don't want to do that now, but you should have heard the term already. So let's say if today I have in my warehouse 60 of inventory and next period I have 80, that means that 20 more of cash is bound in that warehouse. So I have stocked up material, and that's nothing that I'm going to see in my profit and loss statement, but it has been obviously a cash outflow in the period. So I have to account for that. So if I piled up my stock by 20, that means that my cash flow needs to decrease by 20. Okay, and that's a classic change in net working capital. What is part of net working capital is also something that you will see in the pitfalls, but maybe just quickly 3 terms. So watch out for accounts receivable. So what customers owe us, that is one position that we have to keep in mind. Another one is inventory, as I just mentioned. And the third one that is classically in there is accounts payable. So what we owe to our suppliers. So let's say this period I owed 50, next period I owe 80. That's basically 30 of more cash that I still have because I still haven't paid that out. It was part of my P&L, expenses in my P&L, but not yet paid out. So cash flow increases by 30. Okay. Well, and that in the end builds up our free cash flow to firm, which we sometimes call FCF or FCFF. Okay. And for that free cash flow to firm, the appropriate discount rate is the so-called weighted average cost of capital, which we now have to have a closer look into. Just before we do so, and before I tell you more about that weighted average cost of capital, let me lift that secret of ignoring interest payments and calculating, let's say, a wrong tax payment in that free cash flow to firm. The idea is we wanted to figure out a cash flow that belongs to all the capital providers of the company, not just the equity investors. Because the cash flow and the discount rate need to be consistent. So if we take a discount rate that basically reflects the cost of capital of debt holders and equity investors, we also need a cash flow that does the same. And if we have a cash flow and a discount rate where both of the capital providers are reflected, then we can directly calculate the enterprise value. And you guys remember from the beginning of that video, that is exactly what we want to do. We want to calculate an enterprise value. So now the thing with the debt holders is the following, or with debt is the following. Debt creates a weird thing, which is the so-called tax shield. So interest payments are tax deductible. They reduce my tax basis and I pay less taxes to the government. If you distribute money to the equity investors, you do not have the same effect. Equity investors just get money at the very end after taxes have been paid, but debt holders get the money basically before taxes are paid, and the tax base is reduced. So now if we would have taken the correct tax payments in the free cash flow to firm approach, we would have basically already included that so-called tax shield, because the tax payment that we see in the profit and loss statement are the correct ones, but they are lower than they would have been for a fully equity financed company. So the so-called tax shield would have been already reflected there. You can do that. This is what we call the so-called total cash flow approach. You take the correct tax payments, but then you have to make sure that in your discount rate, you are basically then ignoring the tax shield effect. Yeah, and as I said, there is also a name for that approach. It's the total cash flow approach, and I regard that as a very intuitive one, but no one in that world is doing it that way. Yeah? People use the WACC approach, and the WACC approach ignores the tax shield in the cash flow, but takes the tax shield into account when it comes to the discount rate. And here is how that works. Yeah? So if you look into the formula here on that slide 24, yeah, at the bottom, you basically first of all see that there is something that is called REL and something else that is called RD. Those are the cost of equity and the cost of debt. REL is the cost of equity. The L, by the way, stands for levered, but let's not go into detail on that now. And RD is the cost of debt. Yeah? The D obviously stands or represents debt. Yeah? And those two costs of capital are weighted. They are weighted by equity and debt. Yeah? So the cost of equity has the weight of today's equity value, E0, divided by today's equity value plus today's debt value, E0 plus D0. Yeah? And for the cost of debt, it's obviously just the other way around. Yeah? I think makes a lot of sense. But then you see that the cost of debt has an additional multiplier on it, which is 1 minus tau. Tau is again the tax rate, the 30% or 19% or whatsoever. And now the cost of debt, so let's say the interest rate of 5% that I need to pay to the bank or to the debt holders, gets basically reduced in that equation by 1 minus the tax rate. And this is now where the tax shield comes into play. Yeah? So people that are applying the WACC approach basically take the tax shield into account in the discount rate, because they say, so let me take the example of a tax rate of 30%. They say, well, I may pay 5% to the debt holders, but in fact, I'm just paying 3.5% because roughly 1/3, or to be very precise, 1.5 percentage points, I basically get back from the government, yeah, because I'm paying less taxes. So effectively, my cost of debt is not 5%, but it's 5% times 1 minus the tax rate, the 30%, and this is now just 3.5%. Okay, so that's the logic that is applied. So the tax advantage, the tax shield, enters the game, so to speak, via the discount rate, yeah, so in the denominator, and therefore it has to be ignored in the cash flow. And that's the reason why we have calculated the cash flow in that odd way. Obviously, if we take the tax shield into account in the cash flow and in the discount rate, then we have a double count, and double counts are obviously never a good idea. They are a mistake. Yeah? So we have to decide whether to put it into the cash flow or the discount rate, and the whole world is putting it into the discount rate. And that's the WACC approach. Okay, so now you guys know why the free cash flow to firm is calculated the way it is calculated, and you have already, I hope, a rough understanding of that WACC formula here, yeah, this weighted average cost of capital. So now let's have a look a little bit closer into the different components. And as I said, it's a mini lecture, so I cannot really go too much into detail, but let's say I can at least drop some concepts so that you kind of, so either the concepts ring a bell and you say, ah, yeah, I know, I've been there before, or you say, oh, not so much, yeah? Then you know what to investigate further on. Yeah. So the cost of equity is usually something that we get from the so-called CAPM, yeah, the capital asset pricing model. Not a perfect model, to be honest, but that's the one that is also kind of agreed upon throughout the whole world of finance. Yeah, practitioners are using it up and down. Yeah, so in a finance program, we can discuss what are pitfalls here, what are basically maybe other more advanced models that come to better estimates. But for now, let's say the CAPM is the go-to model. Yeah. And whenever you are looking into a publicly listed company, you can really calculate your own beta based on the stock returns of that publicly listed company and the stock returns of some kind of very, very broad market portfolio. Again, nothing I go deeper in here. Either you have heard about that beforehand, or if not, at the very end, I will show some resources where you can go a little bit deeper. Yeah. Okay, so that's the one possibility. Yeah, so if the company you investigate is listed, if it is not listed, you need to transfer your results of that CAPM. So with the CAPM, you estimate a so-called beta factor. You need to transfer that again from some kind of peer. Same logic as with the multiples. Yeah. So as I said, just as a little bit of a teaser, and either you have already heard about that, then that's fine. Otherwise, at the very end, I will show some resources where you could go deeper, either already before the challenge, or I think it's also fine to do that during the challenge. Yeah, you can also learn that on the job, I would say. And for the cost of debt, the good thing is that, first of all, if the companies are not too extraordinary, then basically you can really just take the interest rate that the company pays. Yeah, theoretically that's not the cleanest thing to do, but usually it's sufficient. Yeah, and this interest rate is usually a mix of the risk-free interest rate. Yeah, let's say for a AAA rated government bond, for Germany, for example, or Switzerland or Canada, and some kind of credit default spread. Yeah, so that you say, hey, there is some default risk with that company, and that leads to the fact that the interest rate has to be higher. But usually nothing to bother yourself too much with. Let's say at least in some rather regular valuations. Yeah, so there you can really just take the interest rate that debt holders are asking for. And last but not least, the capital structure. Yeah, so debt and equity. And here people often think that this is easy, that this is something you can basically read from the balance sheet. Unfortunately, that's a little bit dangerous, yeah, because yes, you can read the debt value from the balance sheet, but you shouldn't read the equity value from the balance sheet, because that's just the book value of equity. And the market value of equity is basically what really interests us. Yeah, that's usually also why we do the valuation. And now you see already that's a bit of an issue. You need that to figure out the discount rate. Yeah? But on the other hand, the discount rate is basically what should help you in figuring out that equity value in the end. Yeah? So this is a classic circular reference that needs to be solved. And let's say the first basic idea that people take here is that they go with some kind of target capital structure. Yeah? That they say, hey, such a company with that underlying risk, yeah, in this industry should run with a debt to total value ratio of 30% or 40% or 50%. Yeah, so you can check what our industry peers doing. In, let's say, really going into a master program, we would obviously look into methods in how to figure out in a better way what is the best capital structure to apply. But for the start, you can basically say, okay, what is the industry doing? What seems to be a sustainable capital structure for such a company? Yeah, and that would be your start point here. 30%, 40%, whatsoever. Yeah. Okay, also over the weekend, we can discuss this a little bit and see what is then also for the cases that you have in front of you, what are meaningful capital structures. And I can tell you a little bit further what are basically the drivers of a meaningful capital structure. Okay, yeah, so those are the components first of all. And I hope I have a little bit of an illustrative example here. Yeah, very, very simple. I'm not reading out the numbers, but here you can see, let's say in a little tree, how such a weighted average cost of capital builds up through the different components. Yeah, and last but not least, this is, let's say, a one-slide summary on that WACC approach, which again tells you how to calculate that free cash flow to firm and how to come up with that discount rate, and it also provides some advantages and drawbacks. Yeah. One big advantage, that's the only thing that I really wanna mention, is the WACC approach is so famous because it is quite robust. Yeah? Probably from what I told you beforehand, most of the stuff sounded kind of reasonable. The only thing where you may have thought how to deal with that is probably that capital structure thing. Yeah. So how to know whether you should apply 20%, 30%, 40%, 50%. The thing is that the WACC approach is very, very robust. Yeah. So even if you change the capital structure by 20 percentage points, that is usually nothing that drives the value too much in a different direction. And that's basically a good thing. Yeah. So this is a very, very uncertain assumption, and it has basically not such a big impact on the value. Yeah, and that's really one advantage of the WACC approach in comparison to the equity method, for example, yeah, which we are not going to cover here. But if you go into a finance master program, that's obviously something that we would go deeper in, yeah, to compare with other methods and to see in which cases would other methods be more appropriate. Okay, so that's, I believe, the last slide, yeah, of the chapter number 2. And now let's quickly talk about some common pitfalls and their practical implications. Yeah? So I've tried to summarize some sins of corporate valuation here. I think I decided on 7 that just came to my mind directly. I will just cover the first 5. The other 2 we can also discuss on the weekend. Yeah, I believe they need some more explanation and probably really a case in front of us. But let's say the first 5 is something that I can already get started with. Yeah? And the very first thing we look at is consistency, because that's something that I see going wrong, so to speak, in many valuations, not just done by students, but really also by professionals in practice. Yeah? So let us start with the DCF WACC approach. And sometimes there are just valuation cases where the approach doesn't work. So usually we say in 70-75% of valuations, this is a good approach. It works. Yeah? But in some cases, it just isn't. So one is leverage buyouts. Yeah? So on the second day, actually, we are going to deal with a leverage buyout. When Ardian basically takes over the case, we will look into the rationale of a private equity investor. And they think a little bit different. They do not have a constant capital structure, yeah, where debt and equity have always a constant relation. They start off with a high level of debt, and then the cash flows need to pay back the debt, so to speak. And this is totally against the idea of the WACC approach. And therefore the WACC approach is really not a good concept here. We need something else. Fortunately, we have the Saturday morning of the case challenge where I can tell you how we can tweak the concept of the WACC to basically make it a working discounted cash flow method for such a private equity investment case. Yeah. Another one is, if you want to value a financial services company, then you should rather go for the equity method and not for the WACC approach. I'm not going into the technicalities here, but let's say debt in a financial service company is an odd thing, because all the money that you get from, so as a bank, all the money that you get from your customers is basically nothing where you pay interests on directly, but it's basically money that you use to make your business. And this is also something that is super hard to detect with the WACC approach, and then you rather go directly to the equity side. Okay, but as I said, not too much to focus on here. And the other thing is growth firms, startups, or basically projects that really have some flexible options involved. So here you can probably imagine that, let's say, a free cash flow to firm, which is really just an expected value, is not really helping me a lot if the risk and the variation is super, super high. Yeah? So then I need to come up with something more sophisticated. And to be honest, this is like one of my most favorite topics. Yeah, real options valuation, also stuff I'm researching on. And let's say if investment projects get more complicated, more advanced, then we need to solve that with option pricing approaches. And there you can really create a lot of value for managers in the decision-making process if you are able to build up something like that. Yeah. But as I said, for now, not a topic, will also be not a topic in the case study, I'm pretty sure. Yeah. But you should have that in mind, that that the WACC approach is not something that works everywhere. And for multiples, and I've mentioned that beforehand, there you really have to be a little bit cautious. Yeah, so pretty often I see crazy multiples. Yeah, even in some Harvard business cases, I read stuff like a sales equity multiple, yeah, which is everything is wrong about that. Yeah, so sales is something that still belongs to equity investors and debt holders. The equity value is obviously something that is only attached to the equity investors, so it doesn't make any sense. It's totally inconsistent, and sales is before cost structure anyway, so that's also never a good idea. Yeah, so really make sure that the value driver and the value concept that you are picking is consistent, so that they both belong to the same group of investors. Yeah, so what is consistent is, for example, an EBIT or EBITDA and an enterprise value, as we said beforehand. Yeah, if you would really want to go for a firm value, which you're usually not doing, but if you would, yeah, then it's basically something like the EBIT plus any kind of financial income that you may have from excess cash, yeah, or that you may have from some non-operational financial assets you are holding. Yeah, so stuff like that is possible, and then you would calculate the firm value, yeah, and so on and so forth. So please make sure that when building up a multiple, you are consistent. Okay, so what's the second pitfall? I think the first one is quite trivial. Yeah? For some reason, it still goes wrong sometimes, but I hope not with you guys. The second one is less trivial, yeah, something that I also see more often, which is, at what point in time should we basically jump into that phase 2 in a discounted cash flow model? Yeah, I think the reason why that goes wrong so often is that if you guys do internships or start your careers at some kind of investment banks or M&A advisories or Big Four, there's pretty often, let's say, a standard template. The standard template is estimate the first 5 years of cash flows, and then you go into terminal value. And that might be wrong in most of the cases, but sometimes it just isn't. Yeah, so sometimes the company is still, let's say, on some kind of growth path, and it may take 7 or 10 years to go into a steady state. And then you shouldn't jump too early into that steady state. And now you can say, hey, but how can I know what happens in 7, 8, 9 or 10 years to that company? That's right, yeah. And you shouldn't, let's say, detail out everything. But if in year 5, let's say, your revenue growth estimate is still at 7, 8 or 10%, then you cannot jump into a terminal value where your perpetual growth rate is then suddenly 1%. Yeah, that's just not consistent. That's not logical. Yeah, so this is not how the world would be. Yeah, so probably the growth would slow down over the next 2 or 3 years, and then you would run into that steady state. Yeah, or maybe you have done a huge investment, or you plan a huge investment in 2 years. You want to enter a new market, and probably it takes longer than 3 years to basically build up the full potential in that new market. Yeah, it may take 5, 6, or 7 years. You probably, when you made your investment decision, you had something in mind how long it takes. Yeah, so then also your cash flow plan should reflect it. Otherwise, things are pretty much inconsistent. Yeah. So what is the point I want to make? I hope, yeah, I have a little bit of an example here. By the way, the Excel from where that screenshot is from is also something that I'm going to provide, yeah, so that you also have a little bit of a template. So here in that example, you basically see that after 3, 4, or 5 years, it wouldn't make a lot of sense to basically jump into a terminal value. Why? Because if you look into the growth rate of the free cash flow to firm, yeah, that's the second last line here, that big blue one. Let's say 2025, we are still at 15%. Yeah, so jumping into some kind of terminal value here is super strange. Yeah, in 2027 we are then at 1.7%, and that might be way more reasonable. Yeah, so then that phases out, so to speak. Yeah. Okay. And then let us look into the third pitfall. The third pitfall is basically on the perpetual growth rate. And here the following is the idea. Yeah? So as I told you, people are coming up with 1% or 2%, and then they discuss about, I don't know, inflation, overall economic growth, and they do not really have a concept for that. Yeah? And pretty often it is too low or too high what you are picking. But here comes the idea of how to deal with that. The idea basically is that there is always a relationship between assets and earnings of the company. And in the very, very long run, if you think about it, it is a pretty reasonable idea that you kind of create constant earnings on your asset base. Yeah? So if your asset base is growing, your earnings should grow the same. Yeah, it would be quite odd, let's say, to keep assets constant and still increase earnings. I mean, maybe that's possible a little bit, yeah, so that you get more efficient, but it's not really something that I would assume to infinity. Yeah, so towards infinity, I would rather assume that this keeps constant. Yeah, okay. So therefore, the reasonable case for terminal value calculation is that very first one here. Yeah? And now let us see what that means for a perpetual growth rate. So for a perpetual growth rate, sorry, a little bit too much of animation on those slides. Yeah? So for a perpetual growth rate, you can think about it the following way. Yeah? So today we have an asset base of 100. And there is a return on invested capital. So let's say that gives me my after tax profits, my NOPAT, and this return on invested capital is 10%. So that means I create a NOPAT of 10, and now I can decide how much should be distributed, paid out as a free cash flow to firm, so to speak, to my investors, and how much should be reinvested into the company via capital expenditures. So this retention rate, this reinvestment rate, is something that we call Q. So now let's say that's 20%. Yeah? So 20% I'm reinvesting, so therefore I create new assets of 2. Yeah? 20% times 10, 2. And for those new investments, I basically get 15% of return. That's my RONIC, return on newly invested capital. So this happens, yeah, the other 100, they stay in the company and I get still 10% on that, yeah. But the 15% on the 2, this is basically what comes, let's say, as a growth. Yeah, this is new NOPAT, and this defines the growth. And now you will see that basically the growth rate from one year to another, when we look into the free cash flow to firm, is really just that RONIC times the retention rate. Yeah, so it increases from 8 to 8.24, and this is 3%, and 3% is basically the 20% of retention times the 15% of return on newly invested capital. Yeah. So now what's my point here? My point is that you can always, let's say, validate your growth rate by looking into your financial planning and see, okay, what is basically the retention rate that I'm applying, or the reinvestment rate. All you have to do for that is basically you look into your very last planning year and you see, hey, this is my notepad and this is my free cash flow to firm. So now what is the percentage between? Yeah, so you see that here in this formula, notepad minus free cash flow to firm divided by notepad. This gives you the retention rate. And then you have some kind of growth rate estimate you want to use. Yeah, let's say 2%. And then you have that retention rate, you have the growth rate, and now you can calculate what is your implied RONIC, yeah, your implied return on newly invested capital. And this is something that you can compare to your cost of capital, your weighted average cost of capital. Yeah? And let's say I cannot tell you exactly what's then, so to speak, the right growth rate to take. But what I can tell you is that if you run that little sanity check, you definitely need to find a RONIC that is greater or at least equal to the WACC. Yeah? If it is lower than the WACC, then it doesn't make sense economically. Yeah? That would basically mean I'm destroying value by growing. Yeah? I'm growing my asset base, but the new assets are basically earning less than what would be my cost of capital. And that doesn't make any sense. So this can never be the case. Yeah? So at least the growth rate has to be so high that the RONIC is at least at the level of the WACC. And maybe a little bit higher, but probably not too much. Yeah? So let me say there is a WACC of, I think I have an example on the next slide. Yeah? So let's say there is a WACC of 10%. Yeah? And now I have a retention rate, a Q of, let's take here the case number 1, 16.67%. The growth rate we have picked is 2%, so that means that the implied RONIC is 12%. That's above 10%, and I would say that's reasonable. Yeah? It's just 2 percentage points. We see that empirically, that's something that companies are able to achieve. Let's say if this implied RONIC would be 18 or 20%, I would be doubtful. Yeah, I would say I would be pretty skeptical. Yeah, someone would need to explain that to me. Really, an industry expert saying, "Yeah, that's fine. Yeah, in that industry, that's possible that you are so much above your cost of capital." But usually, it is not. It should be kind of close to your cost of capital, and that will help you a lot. Yeah, because if you think about it, to go up to a growth rate of 3%, yeah, we would basically need to come up with a RONIC that is much higher than the 12%, and then we could directly say, hey, that is not reasonable. So it plays down that reasonable range of growth rates a lot. Yeah, so usually it's really then just within 0.5 percentage points that we are still discussing, so to speak. Yeah, so therefore that's really a great tool to avoid the pitfall of picking wrong growth rates, and it really happens a lot. So I would say in 20% of the valuations from practice that I have lying in front of me, I find that the growth rate is basically too low in comparison to the implied RONIC that has been planned out. Yeah, and that is something that would get directly, let's say when a valuation goes to trial, for example, that's something that experts would directly pick on, and would say, hey guys, that doesn't make sense right from the start. No need to discuss further. At least the growth rate has to be this point, and at least the valuation has to be that, and you have already lost. Yeah, so avoid that, yeah, and use that sanity check to make sure that you find a good growth rate. Okay, yeah, so that's already a pretty advanced concept, I have to admit, but I hope when you're reading up about that, you come already with some good pre-knowledge to the case challenge, and then we can go deeper into that while you're working on the case. Yeah. Okay, the second last thing is on net working capital. Here my only point is really make sure to reflect it, because pretty often I see that it is not reflected, and make sure that the drivers of the net working capital relate to revenues or expenses. Quick, simple example, accounts payable is something that should be attached to the cost of goods sold. Yeah, so if the cost of goods sold increase by 10% year after year, so should the accounts payable. Yeah, because otherwise I would need to change the payment terms by a lot. But if I believe those are constant, then basically the growth of the costs and the accounts payable have to be the same. Same holds true for inventory, yeah? Like raw materials, finished and unfinished goods should also be attached to the costs. And the accounts receivable, that's something that should be attached to the revenues. Yeah? So in particular in high growth companies, yeah, 20%, 25% of growth for whatever reason, yeah, for some kind of expansion I'm planning, then also the accounts receivable should increase by the same rate. Otherwise something is pretty odd. Yeah, that would again mean that you change payment terms heavily with your customers, which is probably not very reasonable. Yeah, so make sure that the net working capital really, let's say, breathes with the growth pace of your company. Okay, and then last but not least, number 5, non-operating assets. Yeah, so let's say what I see pretty often is that concepts are applied more or less correctly. Yeah, you come up with some kind of equity value. In the end, yeah, from enterprise value, you calculate downwards to an equity value, and then usually the seller tries to sell off many other things. So they say, hey, out of the method, I've calculated that the equity value is 100, but I mean, that's just the equity value. So now then you also have to pay for the property, you have to pay for the plant, you have to pay for the equipment, you have to pay for the inventory. Yeah, and all that is crap. Okay, so that is nothing to take into account. Why? Because when we were coming up with those cash flows, let's say what we need to create those cash flows is property, is plant, is equipment, and it is also inventory. Yeah, so we also have that change in net working capital, that change in inventory already involved. All that is needed to create cash flows. So therefore, adding that, let's say, towards the purchase price is a heavy double count. Yeah, shouldn't happen. Yeah, so when we apply a multiple valuation or a discounted cash flow valuation, everything that is needed to create a profit or a cash flow is already taken into account. Yeah, so also for multiples, in EBIT or EBITDA cannot happen without property, plant, equipment, and the like. Yeah, so therefore no need to double count that. The only thing that needs to be counted in is everything that is really non-operational. Yeah, everything that does not really add to the cash flow or to the performance of the company, but is just there. Yeah, we see that pretty often in mid-sized German companies, yeah, German Mittelstand, where, I don't know, there is some real estate, yeah, that is not used by the company, but maybe it is for rent to someone else. Yeah, or we have a lot of cash lying around that is not needed to run the business. Stuff like that. Yeah, if this is part of the purchase agreement, then yes, this needs to be added separately. But if it is something that is used in operations, then there is no need to add that to the equation. Okay, so that's the very last pitfall I want to mention here and think to watch out for, because that also pretty often goes wrong. Yeah, people tend to increase the value by a lot in such a little value ladder. Yeah. Okay, and then the very last thing that I just, so here are the remedies summarized, yeah, for our sins. And as I said, number 6 and 7 is something that we can discuss over the weekend. And then the very last thing that I just wanna mention, and I'm going to provide links to that, is basically that if you had from that little summary the feeling that the present value concept is something where I need a little bit of a recap, or let's say that capital asset pricing model is maybe something where I need a little bit of a deep dive, then there is the chance to watch some more tutorial videos, because we have a so-called Fundamentals of Finance course that is a preparation course also for our master program, where you can basically step by step in little videos go through some of those basic corporate finance concepts. So usually we do that before the master program starts, to make sure that everyone is kind of starting on common ground. Yeah, but this we would also open up for you guys, and I will share the links to the videos and to the script, so that if you like, you can already have a look in the one or other thing. But let me again say that this is really nothing that is expected or needed. It's really just, if you have a little bit of time and you have the feeling, yeah, that could be interesting for me, then feel free to do it. Yeah, it's nothing that needs to be done before the case challenge. It's really just an offer. Okay, thank you very much. I hope that was helpful and not too much of input. Obviously, also during the case challenge, you are more than invited to give me feedback on that little summary. And again, I'm very much looking forward meeting you all. Okay, all the best. Bye.